A 62-year-old retiree in California followed every rule, saved carefully, paid off his home, and still lost over $80,000 almost overnight. Not to a scam, not to bad luck, but to a law he didn't even know existed. And here's the disturbing part. This is happening more often than you think. These are not new laws. They've been quietly enforced for years, hidden in plain sight. Based on recent policy updates, legal reports, and financial studies from 2025 to 2026, experts are now warning that thousands of seniors are walking into financial traps without realizing it. Today, we're uncovering 10 brutal California laws that could quietly wipe out your savings, your home, and your independence before you even see it coming. Number 1. Medi-Cal Estate Recovery Trap. You spend your entire life building something, a home, a small savings cushion, maybe a legacy for your children. And then, after you're gone, it quietly disappears. This is the Medi-Cal Estate Recovery Trap, and most people don't even realize it exists until it's too late. Here's how it works in simple terms. If a senior in California receives long-term care services through Medi-Cal, the state is legally allowed to recover those costs after their death. That means the government can file a claim against the estate, often targeting the home or any remaining assets, to repay what was spent on care. And we're not talking about small amounts. Long-term care can easily reach tens or even hundreds of thousands of dollars over time. The shocking part is that many seniors assume their home will automatically pass down to their children. But under these policies, that assumption can be completely wrong. Families often find out only after the loss of a loved one, when they receive a notice that the estate must repay Medi-Cal. It feels sudden, confusing, and deeply unfair, because everything looked secure on the surface. Based on Medicaid recovery policies and recent legal updates, this is not a loophole, it's a standard process that quietly affects thousands of families every year. But here's where awareness changes everything. There are legal and practical ways to protect what you've built, if you act early. Tools like living trusts, proper estate planning, and asset protection strategies can help shield your home and savings from recovery claims. Even small steps taken at the right time can make a massive difference in what your family keeps. So ask yourself this: if something happened tomorrow, would your assets go where you expect them to go or somewhere else entirely? This is exactly why staying informed matters. If this opened your eyes even a little, make sure to like this video, subscribe to the channel, and stay with us, because the next law might be even more surprising, and it could impact your life in ways you never imagined. Number 2. Property tax reassessment shock. Imagine handing your home to your children as a gift, thinking you're securing their future, only to trigger a tax bill so high that it puts the property at risk. That's exactly what's happening under California's Prop 19, and most people don't realize the impact until it's already done. For years, families relied on older rules that allowed property to pass from parents to children without a major tax increase. But Prop 19 changed that. Now, in many cases, when a home is transferred, it gets reassessed at current market value, which can instantly multiply the annual property tax. And here's where it gets dangerous. Many seniors are trying to help their children by transferring ownership early, adding them to the title, or gifting the home altogether. It sounds like a smart move on the surface, but legally it can trigger a full reassessment. A home that was taxed at a much lower value for decades suddenly gets updated to today's market price, and that can mean thousands of extra dollars every single year. For families living on fixed incomes or trying to hold on to that property, it becomes a silent financial pressure that keeps growing. What makes this even more frustrating is that there are exceptions and rules within Prop 19, but they're not simple and they're often misunderstood. For example, certain transfers may qualify for partial exclusions, especially if the child uses the home as their primary residence. But if even one condition is missed, the full tax increase can still hit. And by the time people realize it, the paperwork is already done and the new tax bill is locked in. So before making any decisions, understanding these rules is critical.
A simple consultation, a proper review of exemptions, or even delaying a transfer could save tens of thousands over time. Because once reassessment happens, there's no easy way to reverse it. Now think about this for a second. Would you still give your home away today if it meant doubling or even tripling your property taxes overnight? That's the kind of question Prop 19 forces families to face, often when it's already too late.
Number 3. Nursing home cost spiral law. There's a harsh reality most people never see coming. Long-term care in California isn't just expensive, it's structured in a way that can quietly drain everything you've saved before help even begins. This is what many experts call the spend-down system, and it's built directly into Medi-Cal eligibility rules. In simple terms, before you qualify for Medi-Cal coverage for nursing home care, you're often required to use up a significant portion of your own assets first. That means your savings, investments, and sometimes even parts of your estate are gradually consumed, month by month, until you fall below certain financial limits. And here's where it becomes overwhelming. Nursing home care can cost thousands of dollars every single month. For many seniors, that translates into years of disciplined saving disappearing in what feels like a very short time. Families watch accounts shrink, decisions become urgent, and options become limited. It's not because of poor planning or bad choices, it's because the system is designed to prioritize personal funds before public support steps in. The emotional weight of this is heavy because it's not just about money, it's about security, independence, and the life you worked decades to build. What makes this even more difficult is that many people assume Medicare or standard health insurance will fully cover long-term care, but in reality, coverage is often limited and temporary. Once that window closes, the financial responsibility shifts back to the individual. And without a plan in place, the cost spiral begins, slow at first, then suddenly accelerating as care needs increase. But awareness can change the outcome. Planning early, especially through long-term care insurance or structured financial strategies, can protect a significant portion of your assets. Timing is everything here. The earlier these decisions are made, the more options remain available and the less pressure families face later on. Because in the end, this isn't just about healthcare, it's about control. And without preparation, the system can quietly take control for you, turning years of savings into just a few months of survival.
Number 4. HOA fine explosion rules. It starts with something small, a mailbox that doesn't match the approved color, a slightly overgrown lawn, or even parking in the wrong spot for a few hours. Harmless, right? But under many California HOA rules, these minor issues can quickly turn into a financial nightmare. Homeowners associations have the legal authority to issue fines, add late fees, and in some cases, place a lien on your property. And once that process begins, it can escalate far faster than most people expect. Here's what makes this especially dangerous for seniors. Many are living in planned communities or neighborhoods governed by HOAs, often chosen for safety and stability. But hidden inside those agreements are enforcement rules that can be strict, complex, and sometimes aggressively applied. A single overlooked notice or misunderstood guideline can trigger a chain reaction. Initial fines grow, penalties stack, and before you know it, you're dealing with hundreds or even thousands of dollars in charges. And it doesn't stop there. If fines remain unpaid, HOAs in California can legally move toward placing a lien on the home. That means your property itself becomes tied to the debt. In extreme cases, this can even lead to foreclosure proceedings, not because of a mortgage issue, but because of unpaid HOA penalties. It sounds unbelievable, but it's completely legal under current regulations. What adds to the problem is communication. Notices are often sent by mail or email, and if they're missed, misunderstood, or delayed, the situation can escalate silently. Many seniors don't realize how serious it has become until the fines have already grown significantly, and at that point, resolving the issue becomes much more stressful, time-consuming, and expensive. The key here is awareness and attention to detail. Reviewing HOA agreements carefully, staying on top of community rules, and responding quickly to any notices can prevent small issues from turning into major financial problems. Because in these communities, it's not always the big mistakes that cost you. Sometimes it's the smallest ones that grow the fastest.
Number 5. Insurance non-renewal crisis. You pay your insurance on time for years, never miss a bill, never file a major claim, and then one day a letter shows up saying your coverage will not be renewed. No warning, no negotiation, just a deadline. This is the insurance non-renewal crisis unfolding across California, and it's hitting seniors especially hard. Due to rising risks from wildfires, climate patterns, and increasing costs, many insurance companies are legally choosing to reduce their exposure by dropping policies in certain areas. And the worst part is, they're allowed to do it. For seniors living on fixed incomes, this creates immediate pressure. Losing coverage doesn't just mean inconvenience, it means entering a rushed, stressful search for alternatives in a market where options are shrinking. New policies often come with significantly higher premiums, reduced coverage, or stricter conditions. In some cases, homeowners are forced into last resort programs that provide only basic protection at a much higher cost. What used to be a stable, predictable expense suddenly becomes unpredictable and overwhelming. And here's where the hidden impact shows up: time. Hours, sometimes days, are spent comparing policies, making calls, filling out applications, and trying to understand complex terms under pressure. For many older homeowners, this process is exhausting and confusing. It's not just a financial burden, it's a mental and emotional drain that comes out of nowhere. What makes this even more concerning is that non-renewal doesn't always mean your home became unsafe overnight. It often reflects broader market shifts that are outside your control. Entire neighborhoods can be affected at once, leaving homeowners scrambling at the same time, competing for limited options. The reality is, relying on one insurance policy long-term is no longer as secure as it once was. Regularly reviewing coverage, understanding backup options, and staying informed about regional risk changes can make a critical difference. Because in today's environment, insurance isn't just about protection, it's about staying one step ahead of a system that can change without warning and leave you exposed when you least expect it.
Number 6. Capital gains tax surprise. You sell your home, expecting relief, maybe even a fresh start, and then a large portion of your profit quietly disappears into taxes you didn't fully anticipate. This is the capital gains tax surprise, and it's catching many California seniors completely off guard. On the surface, selling a property, especially after years of ownership, feels like a financial win. But once the sale is complete, the numbers can shift quickly, depending on how the gain is calculated and what exemptions actually apply. Here's the part many people misunderstand. While there is a federal exclusion that allows individuals or couples to shield a portion of profit from taxes, not everyone qualifies fully. The rules depend on how long you lived in the home, whether it was your primary residence, and how frequently you've used the exemption before. And in California, there's no separate state-level exclusion for capital gains. The profit can be treated as regular income at the state level, pushing you into a higher tax bracket without you realizing it beforehand. For seniors looking to downsize, relocate, or free up equity, this becomes a major shock. A home purchased decades ago at a much lower price may have appreciated significantly. That sounds like a good thing, until you realize that the larger the gain, the higher the potential tax burden. Suddenly, the amount you expected to walk away with shrinks, affecting your next move, your retirement plans, and your overall financial stability. What adds to the confusion is timing. Selling in the wrong year or without coordinating with other income sources can amplify the tax impact. For example, combining a home sale with withdrawals from retirement accounts in the same year can push total income higher, increasing the percentage owed. These are small details, but they can have massive consequences. The key here is understanding the full picture before making a move, planning the timing of the sale, reviewing eligibility for exclusions, and estimating the true after-tax outcome can prevent unpleasant surprises. Because when it comes to capital gains, it's not just about how much you earn from the sale, it's about how much you actually get to keep once everything is said and done.
Number 7. Required minimum distribution penalties. It sounds like a small technical rule, something buried deep inside retirement account paperwork, but ignoring it, even by accident, can cost you thousands. This is the required minimum distribution rule, often called RMD, and it's one of the most overlooked financial traps for seniors. Once you reach a certain age, the government requires you to start withdrawing a minimum amount each year from certain retirement accounts, like traditional IRAs and 401ks. It doesn't matter if you need the money or not, the rule still applies. And here's where things become dangerous. If you fail to withdraw the required amount, or even withdraw less than what's mandated, you can face steep penalties. Historically, those penalties have been extremely high, taking a significant percentage of the amount you should have withdrawn. Even with recent adjustments to penalty rates, the financial hit can still be painful, especially for retirees trying to preserve their savings. What makes this rule tricky is how easy it is to miss. The calculation isn't always straightforward. It depends on your age, your account balance, and specific IRS tables that most people never fully understand. If you have multiple accounts, the complexity increases. One small oversight, one delayed withdrawal, or even a misunderstanding of the deadline, and suddenly you're dealing with penalties that feel completely unnecessary. For many seniors, the frustration comes from the fact that they did everything right. They saved consistently, planned for retirement, and avoided risky decisions. Yet this rule introduces a layer of complexity that requires ongoing attention year after year. It's not a one-time action, it's a recurring obligation that never really goes away. There's also a timing issue that many people underestimate. Withdrawals must be made within specific windows each year, and delaying them, even unintentionally, can trigger consequences. And because these withdrawals count as taxable income, they can also affect your overall tax situation, potentially pushing you into a higher bracket if not planned carefully. The safest approach is to simplify wherever possible. Automating withdrawals, consolidating accounts, and reviewing your required amounts annually can reduce the risk of mistakes. Because with RMDs, the danger isn't obvious, it's quiet, technical, and easy to overlook, but when it hits hard. Number 8. Elder financial abuse liability gaps. It doesn't always look like a crime at first. Sometimes it starts as a small favor, a trusted person helping manage an account, or a simple phone call that sounds completely legitimate. But for many seniors in California, these situations can quietly turn into financial abuse. And what's even more shocking is how difficult it can be to recover the money once it's gone. This is where the system reveals a hidden weakness. While laws exist to protect seniors, the gaps in enforcement and recovery can leave victims exposed. Here's the reality. Elder financial abuse cases are rising, especially with the growth of digital banking and online transactions. Scammers, and sometimes even people close to the victim, exploit trust, confusion, or lack of oversight. Money can be transferred, accounts drained, or assets manipulated in ways that aren't immediately obvious. And by the time it's discovered, the damage is already done. Now, you might think the legal system steps in quickly to fix this, but that's not always how it works. Investigations can take time. Proving abuse requires evidence, documentation, and often lengthy legal processes. In many cases, even if the wrongdoing is confirmed, recovering the lost funds becomes a challenge. The money may already be moved, spent, or hidden in ways that are difficult to trace. So while the law recognizes the problem, it doesn't always guarantee a fast or full recovery. For seniors, this creates a dangerous situation where prevention becomes far more important than reaction. Because once the process begins, it's not just about money, it's about stress, uncertainty, and the emotional toll of realizing trust was broken.
Families often step in, trying to fix things, but even they face legal and procedural hurdles. What makes this even more concerning is how subtle these situations can be. There's no dramatic moment, no clear warning sign, just small, gradual changes that go unnoticed until they become significant. That's why awareness and simple safeguards can make a critical difference. Setting up account alerts, assigning a trusted contact, regularly reviewing transactions, and limiting access where possible. These steps may seem basic, but they create layers of protection that can stop problems before they grow. Because in the end, the system may help, but it often helps after the damage is already done. Number 9. Reverse mortgage risks. It sounds like the perfect solution. Turn your home equity into cash, stay in your house, and remove financial pressure during retirement. For many seniors in California, reverse mortgages are presented exactly this way: simple, helpful, and safe. But behind that simplicity lies a set of rules that can quietly shift control of your most valuable asset, your home. And if those rules are misunderstood, the consequences can be serious. Here's how it works in basic terms. A reverse mortgage allows homeowners, typically over 62, to borrow against the value of their home without making monthly payments. Instead, the loan balance grows over time and is repaid later, usually when the homeowner sells the property, moves out permanently, or passes away. On the surface, it feels like accessing money you already own, but the key detail many people overlook is that the loan is still active and certain obligations must be met at all times. This is where problems begin. Borrowers are still required to pay property taxes, maintain homeowners insurance, and keep the home in acceptable condition. Missing any of these requirements can trigger a default, even if no monthly loan payment is due. That means the lender can step in and potentially force repayment or foreclosure. For seniors living on tight or fixed incomes, even a temporary financial setback can lead to missed obligations, and that's when the situation escalates quickly. Another hidden risk involves heirs. Many families assume the home will automatically pass down to children or loved ones, but with a reverse mortgage, the loan must be settled first. If the balance has grown significantly, heirs may be forced to sell the home to repay the debt. In some cases, they may not have the financial ability to keep the property, even if they want to. What makes this especially tricky is how the benefits are emphasized early on: immediate cash flow, financial relief, no monthly payments. But the long-term structure, the compounding interest, the growing balance, and the strict requirements often isn't fully understood until much later. This doesn't mean reverse mortgages are always a bad option, but they require careful consideration, clear understanding, and proper planning. Because once the agreement is in place, the rules don't adjust to your situation. You have to adjust to them. And if those rules are overlooked, what seemed like a financial lifeline can slowly turn into a loss of control over the place you call home.
Number 10. Digital privacy and scam exposure gap. The biggest threats to your savings today don't knock on your door. They appear on your phone, your email, or even inside a message that looks completely normal. And for many seniors in California, this digital shift has created a dangerous gap where the law exists, but protection doesn't always arrive in time. This is the digital privacy and scam exposure gap, and it's growing faster than most people realize. Here's what makes this so serious. Modern scams are no longer obvious. They don't look like fraud. They look like trusted institutions, banks, government agencies, even family members. A message arrives saying there's a problem with your account, or a call comes in warning about suspicious activity. It feels urgent, real, and personal. And in that moment of pressure, decisions are made quickly. Clicking a link, sharing a code, confirming a detail. That's all it takes. Now, you might assume that once fraud happens, the system steps in and fixes it. But in reality, recovery is often limited. Banks and institutions may investigate, but reimbursement isn't always guaranteed, especially if the transaction appears authorized on the surface.
Law enforcement can get involved, but digital criminals often operate across borders, making them difficult to trace. So while laws exist to address fraud, they don't always prevent the loss or ensure the money comes back. For seniors, this creates a situation where awareness becomes the first and strongest line of defense, because unlike traditional threats, these scams evolve constantly. What worked last year is replaced by something more convincing this year, and the speed at which they operate means there's very little time to pause, think, and verify. There's also a hidden productivity cost here. Hours are spent dealing with locked accounts, reporting incidents, resetting passwords, and trying to restore normalcy. It's not just about the money lost, it's about the disruption, the stress, and the feeling that something private has been exposed. What makes this gap so dangerous is its invisibility. There's no warning sign before it happens, no clear moment where you know you're at risk. Just a normal day, interrupted by something that looks routine. And that's exactly why it works. Because in the digital world, the most dangerous threats are the ones that feel the most familiar. These laws don't knock, they wait, quietly, until the moment you can't undo the damage. If even one of these caught you off guard, don't keep it to yourself. Hit like so more people see this before it's too late, and share it with someone who needs this warning. Subscribe now, because the next video might be the one that saves you thousands, or even everything you've worked for.